Students, what's the case study about? It says Thai's economy's prospects improve, right? So Thai meaning Thailand. Thai's economy's prospects improve. Now table 1.1 shows total expenditure in Thailand by category 2014. So in 2014, what was the total, what was the total expenditure in Thailand based on different categories, right? So what were the expenditure in Thailand in different categories, right? How much was the household consumption? You are given US $243 billion and national expenditure. It was 55.6% of the total national spending. Spending on capital goods, which firms make, was $98 billion, and that was 22.4% of the total national spending. Government consumption was how much? 69 million, which was 15.8. Exports were $280 billion, and they were 64.1% of the national spending, and imports were 253 billion dollars, and the total percentage was 57.9. Is this clear, students? Are we good? Can we move on? Okay. Now, Thai's economy shows improved health. The latest figure shows that Thai's economy grew by 3.5% in the second quarter, putting it on track for 3.5% growth for the whole 2016, right? So the Thailand economy is expected to grow by between 3 to 3.5% in 2016. Thailand has managed to boost its growth after several quarters of disappointing performance by increasing public sector investment in several large infrastructure projects, including roads, railways, and airports, right? So Thailand has managed to boost its growth after several quarters of disappointing performance by increasing public sector investment in several large infrastructure projects, including roads, railways, and airports. These projects will run over next 3 to 5 years and are worth several hundred billion baht. This is their currency. Thailand's currency. It is hoped that this public sector investment will encourage the private sector to increase their investment spending. It is hoped that this public sector investment will encourage the private sector to increase their investment spending. In addition to increased investment, the Thai's economy's growth is being boosted by recovering private consumption due to increase in farm prices, right? So Thailand's economy is also recovering due to private consumption due to increase in farm prices, right? Which are crucial to household purchasing power as well as strong tourism sector, right? Okay, now what's happening over here, students, that apart from the government spending more on big infrastructure projects, as it's mentioned over here, and what projects they are doing, they are developing roads, railways, and airports. And these projects are expected to last between 3 to 5 years and are worth several billion 100 billion baht, right? Their local currency, right? Now, it is being expected that this government spending would also boost private spending, right? Yes or no? It is hoped that this public sector investment will encourage the private sector to increase their investment spending. So due to government spending more, it's expected that the private sector will also spend more. In addition to increased investment, the Thai's economy's growth is being boosted by recovering private consumption, right? So consumption is also being recovered due to increase in farm prices, right? Farm prices could be their house prices or something, right? Which are crucial to household purchasing power as well as strong tourism sector. Regarding the export sector, which remains the biggest engine of growth, the outlook is still uncertain, but negative impact from China's economic slowdown appears to have stabilized with a Chinese growth rate of around 6.6% per annum, right? Now, why would China slow down be a problem for Thailand? Students, so why, if China is slowing down, right, China's economic growth is less, why is that a problem for Thailand? Can anyone of you tell me? Right, that's what the question is saying, right? That's what the passage is saying, right? Which remains the biggest engine of growth. The outlook looks uncertain, but the negative impact from China's economic slowdown appears to have stabilized with Chinese growth rate of around 6.6% per annum. So why is China's slowdown a problem for Thailand? Any guesses, any idea? Right, what do you think is the reason, right? No, Abdullah, read it again. Regarding the export sector, which remains the biggest engine of growth, the outlook is still uncertain, but the negative impact from China's economic slowdown appears to have stabilized with the Chinese growth rate of around 6.6% per annum. Now think about this. So if you are an exporter, if a big chunk of your GDP is coming from your exports. You can see it, clearly see it over here, right? So the biggest chunk of your national income is your exports, right? $280 billion, right? So 64% of Thailand's GDP is coming from its exports, right? And I'm assuming that China would be Thailand's major importer, and that's why if Chinese economy is in recession, which means that they will import less, so Thailand's exports would be less, and therefore it would directly impact Thailand's economy. Yes or no? This is making sense. Decrease as China's economy slowed down, causing less exports of Thailand. Absolutely correct. Extract 2. Thailand's tourism industry continues to grow. The Thai tourism industry is projected to record international visitor arrivals of 16.67 million between January and June 2016. Right? So it is expected that between January and June 2016, there will be 16.67 million tourists coming to Thailand, which will be up by 13% over the same period of 2015. Projected earnings are estimated at 824 billion baht, up 17%. The top 3 markets in terms of tourism receipts are projected to be China. So China, most of visitors in Thailand are coming from China, then from Malaysia, and then from Australia, right? China is now by far the largest source of visitors, but there has been a resumption of growth from Russia and Thailand's neighboring countries of Cambodia, Laos, and Myanmar, right? So China is the biggest source of visitors, but there has been resumption of growth from Russia. So some tourists are also going to Russia and to other neighboring countries of Thailand, which includes Cambodia, Laos, and Myanmar, right? So that's a little problem, right? Students, is this simple? So this was a simple and very straightforward case study, right? So we'll now jump to the questions directly. So the first question here says, calculate the level of aggregate demand in Thailand 2014, right? So can you calculate that? May, June 2018. So let me write down the year it is. This is May, June 2018, and that is right. So question here says, students, right, calculate the aggregate demand in Thailand. Let me take to that part of the question, right? So this is the information from which you need to calculate the aggregate demand of Thailand. So let's quickly do this. Yeah, what do you think? What's your answer, students? Did you calculate? What's the answer? Come on, should not take us so long. Okay, so students, what is aggregate demand made up of? Aggregate demand is made up of consumption, investment, which is basically capital goods, government spending, which is referred to as government consumption over here, exports minus imports. So you have to subtract imports. So when you add the first 4 things and then subtract imports, so that gives you a total of $437 billion. So what's the answer here? 437 billion dollars. Any confusion so far? Right? Can you move on, students? Is this simple? Right. Now, the next question here says, in which category of expenditure would the various infrastructure projects be placed? So that should be fairly simple. So the projects that are being undertaken in Thailand's economy, in which category would you place those? That's the question. I mean, Zuhan, think about this. What was the question saying? Aggregate demand. Have you forgotten what aggregate demand is? What is aggregate demand? Aggregate demand is consumption plus investment plus government spending plus exports minus imports. Right? Right? Yes or no? So all you were supposed to do, Abdullah and Zohan, you were expected to add consumption, investment. So capital goods are basically investment. So they have just changed the name or the word to kind of confuse you a bit. Then government spending or government consumption is the same thing, then exports and minus imports. So you add 1, 2, 3, 4, first 4 items are added and the 5th item is subtracted. Yes or no? Easy. Okay, now the B part. In which category would you place the various infrastructure projects, right? So which infrastructure projects is this question referring to? these infrastructure projects, right? So it did tell you Thailand has managed to boost its growth after several quarters of disappointing performance by increasing public sector investment in several large infrastructure projects, including roads, railways, and airports. Which category would it be? Okay, Abdullah, capital. No, this is government spending. Government spending. Abdullah, think about this. The capital goods, I mean, these are capital goods, but what you are missing out over here is that this is the investment. So C plus I. So the I in aggregate demand, which stands for investment, that is private investment. What is that, people? That's excuse me, that's private investment. That's not what we call it's not your government spending, right? So the government spending, since these projects are undertaken by the government, so these infrastructure projects have to be part of government consumption. Abdullah, is this making sense or not? So capital goods, which is investment, this is your private spending, right? Private investment, like private businesses opening up new factories, private businesses opening up new offices, private businesses opening up more outlets. So all of that would be part of investment, capital goods, right? And the government spending would include all the government spending on different things like building roads, railways, education, spending on education, healthcare. So all these go into government spending. Easy? Confusion, any confusion so far? Anything that's not clear? Right? Easy? Absolutely. Very good. Right. Now we'll move to the next part of the question, students. It says, explain how a fall, right? So the question here says, explain how a fall in the rate of interest would be likely to affect expenditure on consumption and exports. How a fall in the rate of interest is likely to affect expenditure on consumption and exports. Yeah, so let's do this, right? So what do you think? First of all, how will that affect consumption? I'll be waiting for you to answer, and then I'll tell you if you have answered it correctly or not, right? Let's see what you've got here. Okay, now let's read it. Consumption will fall as people save more because they will get more profit on saving. If interest rate fall, consumption increases due to less savings. If interest rate falls, okay, a fall in the rate of interest likely to cause, okay, so Abdullah, Abdullah is right. And Zohan, right? People will not save more if interest rate is less. Why would people save more? They will save less. They'll save less. Yeah, no problem, right? With lower interest rates, have a look at this ones. With lower, people receive less return. Let me increase the size of the file. People receive less return. Their savings on their savings, and therefore save less and consume more. Secondly, since interest rates are low, borrowing would be cheaper. Yes or no? Which would encourage to borrow more and eventually invest, eventually to consume more, right? So interest rates have basically lower interest rates can boost consumption in two possible ways. What are the two possible ways? So the first one is, since your return on savings are low now, right? So what would you want to do? You are not interested in saving a lot, right? Because you know that you will not get a lot of money at the end of the day. So instead, what you do, you want to consume more. Secondly, since interest rates are lower, it's easier for you to borrow, like it's cheaper for you, not easier. It's basically cheaper for you to borrow, and therefore that would encourage you to borrow more and consume more. Easy? Any confusion? Right. Now coming to the exports will increase as when the interest rate will fall, there will be hot money outflow, causing the exchange rate to depreciate, leading to cheaper exports, making the demand of exports to rise. Okay, do you agree, Abdullah? So what Zohan has said about the exports thing, that since now interest rates are low, what will that do? That means less inflow. I mean, it's the same way of saying, Zohan. So you were saying that there will be more outflow of cash from Thailand, I'm thinking more on the lines that there will be less inflow. So when there's less inflow, why would there be less inflow? When interest rates are less, portfolio investment. Do you remember portfolio investment we talked about when you make investment in financial assets of a country, right? So less money will flow into Thailand, right? And therefore, less money will flow into Thailand, right? Therefore, there will be less demand for Thailand baht, right? And when the demand for any currency is low, what happens to its exchange rate? Lower the demand, weaker the exchange rate. When exchange rate would be weaker, Thailand products will be more competitive for other countries, and therefore their demand would be higher, hence eventually leading to higher exports. Any confusion so far? Students, anything that's not clear? I mean, foreign direct investment, Abdullah, let me think about this. So when your interest rates are low, in fact, the foreign investment should be more, direct investment should be more. You know why? Think about this. Okay, now the two things are going in opposite direction. Abdullah and Johan, first listen to what I'm about to say, and then we'll move forward, right? So Abdullah, as far as direct investment is concerned, if interest rates are less, most probably you will get more direct investment. Why? Because if, let's say, BMW and any other company wants to set up their production plant in Pakistan, and they know that their banks, like Pakistani banks, are lending at lower interest rate, right? So then they can come in and, capital is readily available at lower interest rates. So they will borrow from the banks, they will set up their operations, and it will be all very cheap for them. On the other hand, when you think about portfolio investment is in financial assets, right? And that's based on how high are the interest rates. So if interest rates are high, the return on financial assets is also expected to be higher, right? So when Pakistan, let's say interest rates are higher, then foreign investors would expect more return on Pakistan stock market, more return on saving money in Pakistani bank, and so on and so forth, right? So when that happens, then you would want to save more. So higher interest rates, higher portfolio investment, higher interest rates, higher interest rates, lower direct investment. This is making sense, Abdullah? Right. Outflow causing people will exchange Pakistani currency into their country, increase by which they will supply, which will increase Pakistani economy. No, I get it. So you're saying that Pakistani people, Zuhan, so I'm commenting on your comment. So you're saying that Pakistanis will move their money out of Pakistan? I mean, that's also another way of looking at it. Exports will fall and imports will increase. No, weaker exchange rate, why will exports fall? Abdullah, I'm not getting what you're saying. Firms will be able to get cheap loans due to less rate of interest, which will enable them to buy advanced technology, which will increase the productivity and the quality, making exports more competitive, leading to more exports. That's another way of looking at it. Zon, good point, good point. So if interest rates are less, then businesses can borrow more cheaply, they can invest in new technology, and by investing in new technology, their products will become more competitive and more exports. That's a good point. But Abdullah, I'm still confused with what you are saying. Why in the long run you expect the exports to fall? Yeah. Okay, now basically the two things that we have identified, students have a look at this. With lower interest rates, there will be lesser inflow of hot money for investment in financial assets, which we call portfolio investment. Therefore, countries' exchange rate would fall, causing Thailand's exports to become more competitive. Easy, we got on this. On the other hand, since interest rates are low, therefore companies can borrow cheaply and therefore can invest in new technology doesn't grow, products competitiveness to increase. Any confusion so far, students? Anything that's not clear? Abdullah, is this making sense? If exports demand will increase, it will cause the prices to rise. Oh, okay, makes sense. Right. So Abdullah, did you mean that in long run exports will fall because of the fact that if demand is more at the moment, then that means higher prices for exports, and higher prices for exports mean that they will have lesser demand in the future? Is that what you meant? Right. That could happen. Correct. But since the question was only talking about right? Since the question is only talking about, usually talks about the short run, right? So you don't need to go in that much. Case study questions are usually talking about short run, right? Until otherwise stated so. So if it explicitly says that what will happen in the long run, only then you need to think about that. Because a case study question is only focusing on what is happening in the economy at the moment. What is happening in the economy at the moment, not something very long term. Easy, students? This is making sense. Are we clear on this? Can we move to the next question? Right. So the next question here says, explain how changes in any three-factor demands might account for the greater rate of growth in numbers of visitors into Thailand from China than from other countries. Right. Now this is interesting. Now students, the question here says that what three factors, how changes in any three demand factors might account for the greater rate of growth in number of visitors into Thailand from China than any other countries. So what factors could cause more Chinese visitors to come to Thailand rather than other country visitors? Because as we know, currently there are a lot of visitors coming from Australia, China, and there was one more country, I'm forgetting, Malaysia, right? So most of the tourists in Thailand are coming from three countries: China, then it's Malaysia, and then it's Australia, right? Cheaper tickets, right? Increase in, yes, absolutely, very good point. Increase in GDP or per capita income, GDP per capita, right? So we'll see into bit. Offered by Chinese airlines from China to Thailand. Very good point. Excellent point. What else? What's the third? Lower exchange rate of Thailand. Absolutely. Very good. Very good. Excellent point. Weaker baht against yuan, right? Chinese yuan. Absolutely. Very good point, students. Okay, nothing but this. Since the question asks you to explain three factors, right? And it's for 6 marks. So 1 point would be for identification and 1 point would be for explanation, right? Now think about the students. Just imagine, why would Pakistanis go more to tourism abroad, right? Now, this is a simple question. Or similarly, if we look into this question, it's asking basically, why would more Chinese investors go to Thailand? So the idea is, right, some of the case studies are easier, right? So this one is particularly, I would say, quite easy, right? So the idea is, students, when China's GDP per capita is increasing, which means on average people in incomes of Chinese people is higher, so that means they have more purchasing power, they have more affordability, right? So they can easily afford to go tourism in any other country, right? So that would definitely increase number of visitors in China compared to other, like more visitors from China compared to other countries. Increase in China's GDP per capita, which is more than any other country from where Thailand gets its foreign tourists, right? Students, this is making sense or not, right? So the idea is fairly simple. So if China's GDP per capita is growing at a faster pace compared to, compared to other countries from where you get the tourists from, right? So that would mean that more Chinese visitors will be coming to your country compared to any other country in the world. So that's the first thing. Then secondly, cheaper flights. Now think about this. This happens all the time, right? So if tickets are cheaper from Pakistan to, let's say, Azerbaijan or any other country, then people are more likely to go to those tourist destinations, because one major expense of that trip is minimized or reduced. Yes or no? Like, international flights are quite expensive, and that's one of the biggest expense. And apart from that, the second one is accommodation, right? So if flights are cheaper for some reason, XYZ, because more flights are flying from China to Thailand and so on, so then a big chunk of your trip, a big cost chunk of your trip would be minimized, and therefore you could expect more visitors from China to Thailand. And last of all, another very good point, as Johan rightly said, that if Chinese currency is becoming stronger against that Thailand currency, right? So then it means that each Chinese yuan will be worth more Thailand baht, right? So if our currency becomes stronger against any other currency, right? So then for Pakistanis, it will be cheaper to travel to that destination. Yes or no? So that's why it will make it easier for us to go and make a foreign trip in that country, right? Very good, excellent, right? Now comes in the last part of the question, last question of the case study, and the question here says, students, okay, discuss whether Thailand's government should be concerned that exports and import spending represents the highest proportion of total spending in Thailand. Interesting, very interesting question, right? So the question says, should the Thailand's government be concerned that the exports and the imports, like the trade, is making the biggest proportion of their aggregate demand? Should they be concerned? Should they not be concerned? What? Visa-free policy could also be a very good point. Yeah, correct. Absolutely. Very good point. Okay, now students, here's the thing. Whether Thailand's government should be concerned that exports and imports spending represent the highest proportion of total spending in Thailand. So what you will do for any such 6 marks question, right? You will make 2 parts. You write the question, divide the question 2 parts. Yes, should be concerned, not be concerned. Yes or no? This is making sense or not, right? So let's talk about the first part where it says, yes, it should be concerned. So what makes you think that Thailand's government should be concerned if most of its aggregate demand is coming from tourism? No, sorry, not from tourism, from trade, exports and imports. Why should Thailand's economy be concerned if most of its aggregate demand is coming from its trade, exports and imports? What do you think? More vulnerability? Why would the economy be vulnerable? Can you tell me? Right? Economic, trading partners can is it making sense or not? Right. Now, the idea here is fairly simple and easy. Now, more vulnerability because any changes in economic progress of major trading partners can negatively affect Thailand's exports and so could significantly reduce the country's GDP, right? The idea, what I'm saying here is, as it was also mentioned in the passage, that Chinese economy was slowing down and therefore Thailand was the one that had to face the impact. How so? Because um, you know, uh, they were not able to export a lot of goods to China, right? Because Chinese economy is slowing down, which means that now they're importing less. When they're importing less, so Thailand being their major exporter is now exporting less. And when that happens, that increases the vulnerability of the economy. Yes or no? Right. And deficit to the balance of payments. Very good. Excellent. Could lead to, right? Lead to deficit in the BOP, and we do know which would cause depletion of foreign, currency reserves. Yes or no? This is making sense, right? So that's another reason why the country should be concerned about that. Okay, what else? What about the imports? So if you're importing a lot from another country, as you can clearly see in the passage, the Thailand economy is also importing a lot from other countries. Imports are also high. Why is that a problem? Students, quickly. Why is that a problem? Thailand will be totally dependent on the exchange rate, which will fluctuate its aggregate demand as the exchange rate will depreciate or appreciate. So to maintain stability, the Thailand will have to switch to fixed exchange rate, for which it will have opportunity cost. Very good point, Zohan. So what Zohan is saying over here, exports will drop and recession, imports will increase. Absolutely. Absolutely. Very good points. Very good points, Abdullah. So what Zohan is saying, that any small, so it's kind of linked to what I was saying, Zohan, because vulnerability increases. I mean, any small change could really affect your GDP for the country. Why? Because I mean, exports and imports are affected by exchange rate, as we already know. They're also affected by how well your major trading partners are doing, right? So if your major trading partners are slowing down, as it was mentioned in the case study, then your exports will decrease, which is obviously not something very positive. So that's a problem. And then what Abdullah is saying is also very correct, that exports can significantly drop when there's a world recession like we experienced in COVID, right? So COVID-19, when economies across the globe were slowing down because of lockdown and businesses were not operating as usual. So that would mean that a country that was too much dependent on exports would significantly face the impact, right? There are some countries that are more dependent on trade, some countries that are less dependent. So during a global recession, countries that are more dependent on trade will be the ones more affected compared to the ones that are less dependent. Yes or no? Is it making sense, students? Right? Which would cause depletion of foreign currency reserves. And yeah, if countries having a deficit, then it will have borrow money from IMF use. Yes, absolutely correct, John. So whenever a country has a deficit on its balance of payments, so there are two options available. So either you borrow money from IMF, which Pakistan often does, or another way is that if you have enough of foreign currency reserves, then you use your foreign currency reserves to finance that. Yes or no? Right? Easy. Okay. Now, why are more imports? Right. Okay. Yeah, sure, Zohan. Sure. So think about this. So the idea is fairly simple, Zohan. When you are when you are importing more, right? So that means you're paying in a foreign currency, right? You're paying in foreign currency, right? Now, eventually, with more imports and less exports. Now, listen to this carefully, right? So you are paying in foreign currency when you're importing, right? And that means whatever foreign currency reserves you have, like whether that be dollars, whether that be pounds, whether that be euros, they will be depleting, right? Because less foreign exchange is coming in the country. When you export something, right, you have the option of converting that currency back to foreign currency. Even if Pakistan doesn't sell footballs or whatever it's exporting in dollars, I mean, with more rupees coming into Pakistan, they can convert the rupees into dollars and have some reserves stocked up for later use. Easy? Is this making sense? On the other hand, when you're importing, you have to pay, they want the payments to be in their currency, right? So you will be paying in, let's say, dollars, or you'll be paying in pounds and euros, right? So with that thing happening, right, your foreign currency reserves will already be depleting. Your foreign currency reserves will already be depleting. Now, a country does need foreign currency reserves for what? To pay off its international debt, to use it for other, in other instances when you have to maintain your exchange rate and all that, right? So those are very precious things, right? So you don't want to waste those on just, on the balance of payments deficit. So then in case you are very low on your foreign currency reserves, it's recommended that you borrow from IMF rather than to use your own, right? So we are just wrapping this up. John, we're just wrapping this up. So quickly wrap this up, and then, we'll continue from here in the next class, right? Okay, did you get this, Zohan? Did you get this part? Okay, now import spending is also a challenge. High dependency on imports is also a problem for the economy, as it shows as any change in trading partners, change in import prices or availability of goods availability of goods could significantly supply of necessary goods, supply of necessary raw material slash capital goods which are needed in your economy, goods and services, right? This is making sense. Students, have a look at this. Now, the idea is, first of all, we talked about how a country will be more vulnerable when it's dependent on exports, right? So if you do not get to export a lot because there's a recession going on in the international economy or something of the sort, so then you don't export much. When you don't export much, what happens basically that your aggregate demand would be really low, and when your aggregate demand is low, your GDP would be affected. So that's the first thing. Secondly, with lesser exports, we also said that you could go into a balance of payment deficit, which would either cause depletion of your foreign currency reserves, or you would need to borrow from IMF. Now, the third and the last point, I've said that why is it's a problem? Why is this a problem? That you have a high dependency on imports. So high dependency on imports basically means that you're importing important raw material, capital goods, and all that. So if for some reason the countries that you are importing from could not meet your demand, and there could be a couple of different reasons why that could happen, right? So if the countries you are importing all these necessary raw materials and capital goods from could not meet your demand, then you would not have enough of raw material and capital goods to produce enough goods and services, right? So that means that your economies would be stuck, and the production of your economies would be less, and all that. Easy? This is making sense, right? Okay, now on the no part, why should the country not be concerned? Why should the country not be concerned, right? So it should not be a concern even if local consumption, now listen to this very carefully. Spending is fluctuating, country always has the option yes or no. Don't think about this very carefully, right? So what I'm saying over here is that the good thing about, like, why should a country not be concerned? A country should not be concerned because even if the local consumption, if the other components are are reducing, right? So let's say if for some reason local consumption is low, or capital investment, or investment of your country is low, and government spending is low, right? So that would mean your overall aggregate demand is less, and therefore less GDP and all that. But if a country, on the other hand, is getting most of its growth from exports, right? So then that provides as a buffer. That provides as a buffer. Why? Because even if local spending is less, you can always make that up through. You can always make that up through more exports. Is it making sense, right? No, I don't have Lenovo. I have Dell. Dell. Lenovo is not bad. I mean, it's cheaper. It's good. Okay, students, the class is ending. Quickly join with the same link. We'll quickly discuss the answers, and then we'll stop here. Quickly rejoin, please.